Hello, welcome to Session 11 of the Basic Tax course. We begin Session 11 with a review of the Session 9 quiz answer key. I have in front of you now the Session 9 quiz, and we'll take a look at the most frequently missed questions from this particular quiz. Beginning with question number 2. Deductible miscellaneous expenses subject to the 2% of adjusted gross income limit could include broker's commission paid in connection with your investment property? No, that's one of the items that we specifically told you was not allowed. B, investment-related seminars. No, that's another one we specifically pointed out is not allowed for in Pub 17. C, professional accreditation fees paid to enter a new trade. And the answer is no with an exclamation point. The reason for that is that anytime you have any costs associated with beginning a new career in a new profession, those costs are non-deductible under the rules for miscellaneous employee business expenses. Finally, dues to professional associations? Well, yes. So if you are a tax preparer and you decide to join the National Association of Tax Preparers or another group of tax preparers in your area, that professional association due is deductible to you. Similarly, doctors often belong to doctors' associations, and attorneys belong to attorneys' associations, and teachers belong to teachers' associations. Those are deductible. Number 4, employment agency fees that you pay to obtain a job in a new field are deductible as a miscellaneous deduction. The answer to that question is false. Again, we are looking at the cost of obtaining a new job in a new field, and the cost of entering into a new occupation is never deductible. So the costs to enter into a new profession are not deductible, thus the answer to number 4 is false. Moving on, the next most frequently missed question was number 11. In March of 2010, John's motorhome was destroyed in a tornado. The motorhome cost him $65,000, and it had a fair market value of $35,000 on the date of the tornado. His insurance reimbursement was $25,000, and his AGI was $50,000. What is John's casualty loss deduction for the year? Well, when we give a problem like this is a multi-step problem. You have to remember all of the rules that apply. The first rule is that you go with the lesser of the difference in fair market value or the cost basis. And in this case, the fair market value is less than the basis, so that's the number we begin with, $35,000. We then look to insurance reimbursement, and that was $25,000. So logically, we're going to take the fair market value before the event, $35,000, subtract out $25,000 of insurance reimbursement, and we're left with a net $10,000 loss. The next step is to apply the adjusted gross income rule. That's 10% of his AGI, and his AGI is $50,000. $50,000 times 10% is $5,000. So we know $5,000 of the loss is not going to be allowed. We also have to remember to apply the $100 rule. So in the end, we take the $10,000 of net loss minus the $5,000 for 10% of his AGI minus the $100 rule, and we're left with an allowable loss of $4,900, which is answer number B. Number 12, which of the following is deductible as a casualty or theft loss? Loss of your diamond ring at a sports event? Sorry, not allowed. Damage to trees caused by Dutch elm disease? Sorry, that also is not allowed and is an example of something we specifically gave you during our last lecture. Damage caused by vandalism, absolutely, and damage caused to trees caused by accidental application of the wrong chemicals. Again, that is one of the items that we discussed with you in our session on casualty losses, where the IRS has said that is an allowable situation. Now, we gave you an offer of both A and C or both C and D, and the correct answer is F, both C and D. I should point out that this type of question would not be asked on a government-administered exam simply because they reserve the number of questions they have to 4 or less, and we've thrown in a total of 6 possibilities. But the reason we do that is we want to test your mind a little bit more and make sure you're grasping concepts. Here is the mini problem for this particular quiz. Donald was very unlucky this year. In September, Hurricane Daisy severely damaged his home. Hurricane Daisy did not create a federal disaster area, and Donald had the following losses. Well, the first thing I do when I approach a problem like this is pretend that I don't actually have the form and apply all of the laws that relate to this problem before I even get to the form. That way, when I get to the form, I'm ensuring that as I'm filling it out, I'm applying the laws as I understand them. And then when I get to the bottom, I compare what I think should be the answer on the bottom line of the form to what the bottom line of the form is actually showing. And here's how I went about doing that. We look at the property that was destroyed, and we see that there is a home with a cost of $200,000, a fair market value before the event of $400,000, and a fair market value after the event of $300,000. We take the lesser of the cost basis, or the difference in fair market value, and the difference in fair market value is $400,000 minus $300,000, $100,000. So then we look also at the insurance reimbursement. And the insurance reimbursement was $100,000, so a difference in fair market value of $100,000 minus insurance reimbursement of $100,000 means that there's actually zero allowable loss on the home itself. Next in line is the car. It cost $30,000. It had a fair market value of $15,000, and then a fair market value after the event of $0. So the lesser of those two numbers is the difference in fair market value, and that is $15,000. We also need to look at insurance reimbursement. 15 minus 10 is a $5,000 loss on the car. Next in line is household property with a cost of $50,000, a fair market value of $30,000, a fair market value after the event of $25,000. So that means that we have a $25,000 loss on the difference in the fair market value before and after the event. But then we have to subtract out the insurance reimbursement. So we then have 25 minus 2 equals a $23,000 loss on the household property. We then move on. In a separate incident in November, Donald lost his prized dog, Pluto, who ran away from home and was never seen again. Poor Pluto. So we have the prized dog with a cost of $1,500 and a fair market value before the event of $1,500, a fair market value after the event of $0, and no insurance reimbursement. But sorry, the IRS does not allow losses on strayed pets, so the loss is not allowed. Donald paid state income taxes totaling $6,000, real estate taxes of $4,000, and $15,000 of mortgage interest. His AGI for the year was $75,000. Please prepare his Schedule A and Form 4684 and then answers questions 12 through 13. Well, before I even get to the forms, I wanted to finish calculating the loss. And so I took the $5,000 loss on the car, $23,000 loss on the household property, and that gave me a total allowable loss of $28,000. I then have the adjusted gross income of $75,000 times 10% equals $7,500. I then apply the $100 rule, and so I end up with $28,000 minus $7,500 minus $100 equals $20,400. I already know before I even get to the form what Donald's allowable loss is, but let's go ahead and fill out the form just to see how all of it works. And here I have Donald's form for his casualty loss. And you can see that we've listed the home at 1010 Disney Way, the car, and the household property. We then show the cost basis of each asset as was provided for in the problem, and we show the insurance or other reimbursement that he received. We look at the fair market value before the event and the fair market value after the event, and then we subtract out the fair market value before and after and enter that total on line 7. We then look to the lesser of the difference in fair market value or the cost basis and enter the smaller of those two numbers on line 8. And in this situation, the difference in fair market value on the home is the smaller number, and the difference in fair market value on the vehicle and the household belongings are all smaller. So those are the numbers that we end up working with. Next, we subtract out insurance reimbursements and get our total allowed loss on line 10 of $28,000. So that was exactly as I expected it. Here you can see the $100 rule being applied, giving us $27,900. Next step is to apply the 10% of AGI rule, $7,500, and that gives us, surprise, surprise, the allowed loss of $20,400. You can see that when I described the problem, I applied the 10% rule first. That's just the way it works in my mind. If you want to apply the $100 rule first and then the 10% rule, that's fine. But of course, when you fill out the form has the $100 rule applied first. Now, on the Schedule A, we enter the income taxes for Donald, the real estate taxes for Donald. We also enter the mortgage interest for Donald. We did treat that as having been reported on a 1098, and you can assume we mean 1098 unless we tell you otherwise. And then we have a casualty or theft loss for Donald on line 20, so the total amount to enter on line 29 $45,400. So that concludes our review of the Session 9 quiz answer key. At this point, we'll move over to a review of the Session 10 homework assignment. And here is the Session 10 homework assignment. It involves preparation of a tax return for Mary Poppins and preparation of Forms 1040, 8863, 8880, and Schedule M. Mary Poppins is single and lives in Topeka, Kansas. She has a 17-year-old daughter, Jane. Mary also paid the cost of supporting herself and Jane. During the year, she was also a half-time student at Washburn University, where she is enrolled in a degree program and is in her sophomore year. Her Form 1098-T shows her tuition and qualified expenses for the year were $400. This was Mary's first college experience. So that piece of information should be telling you that she is eligible for the American Opportunity Credit. So she needs to be in a degree program, she needs to be half-time, and she needs to not already have a college degree. So we've given you all of the factors, and she meets all of those tests, and so she's eligible for that credit. Mary used money from her student loans to pay the tuition, so her expenses were not out of pocket. Well, if she's liable for that debt and needs to repay it, then she is out of pocket, so to speak, just not today, at some point in the future, and as a result, her expenses are still going to be allowed. Mary had $1,000 of dividend income and paid $300 of foreign tax on those dividends. We have not told you that it appears on a 1099 DIV, but that is what we're getting at here. So we're going to enter that amount, but we won't need to complete Form 1116. Mary's W-2 is attached. You can see she had $35,600 of income. She sent $500 to her 401k plan. Let's prepare her tax return. So here we have the answer key for Mary's tax return. Beginning with the education, again, even though Mary says that her expenses were not out of pocket, the student loan does have to be repaid. Qualified expenses paid with proceeds from student loans do qualify for the education credit. Mary is in the second year of a degree program and is at least a half-time student, so she does qualify for the American Opportunity Credit. The credit is 100% of the first $2,000 she spent. Since she only spent $400, the credit will be $400, but it will be allocated 60% non-refundable and 40% refundable. Therefore, $240 is non-refundable, $160 is refundable. Mary is head of household, but her daughter Jane does not qualify her for the child tax credit. Here is the 1040 for Mary. We can see that she's filing head of household. She has her daughter Jane. She's claiming 2 exemptions. She has $35,600 of wages, and she is reporting dividend income of $1,000. Her income or adjusted gross income for the year is $36,600. She will claim the standard deduction for head of household. She will claim 2 personal exemptions. That gives her taxable income of $20,900 and tax from the tax tables of $2,541. Next in line, we look at what credit she's allowed to claim, and one of those is the foreign tax credit in the amount of $300. And we also have the education credit of $240. Now, on line 50, we see that we have entered a retirement savings contribution credit for Mary. I don't know if you picked up on that one or not, but she is eligible. So let's go take a look at that particular form for her. We can see that she made a contribution to her retirement plan in the amount of $500. Even though it was a salary deferral and she's paid no tax on that money, she is still eligible to claim the credit. We look at her income and where she falls on the scale. And for head of household, $36,600 of income, she falls on this line, and you carry it across, and that's a 10% credit. So 10% of $500 is $50. We then subtract the value of other credits from her tax to see if she still has enough tax to benefit from the retirement credit, and she does, so the credit is allowed in full. And we carry the amount on line 14 back up to Form 1040 and enter that on line 50. Now here we have the American Opportunity Credit calculation for Mary Poppins. We enter Mary Poppins in the student name because Mary is the student, and her Social Security number, the amount of qualified expenses that she had, and the maximum amount of expense that will qualify for the credit. On page 2, we take that expense and divvy it up into 2 sections, the first section being used to calculate the refundable portion, and the second section being used to calculate the non-refundable portion. Back up to her tax return, we see the non-refundable credit. We see the retirement savings contribution credit. Her total credits are $590. That reduces her tax bill down to $1,951. She had $1,500 of withholding on her W-2, a $400 making work pay credit, a $160 refundable American Opportunity credit, making her total withholdings and credits $2,060. That is more than her tax, so she gets a modest refund of $109. So that completes the review of the Session 10 homework answer key. At this point, please push pause and take the Session 10 quiz. When you are finished with the Session 10 quiz, please resume video playback and begin watching the Session 11 lecture. And let's begin with the Session 11 lecture. Today's topic is one of my favorite topics. I absolutely love talking about credits, and I think I told you at the beginning of Session 10 that that was the case. But on Session 11, we get into the credits that I really love computing. Particularly among those are the Earned Income Credit. I've always felt during tax season when I'm able to calculate Earned Income Credit and give it to my clients that I'm a little bit like Santa Claus. So it's just a piece of personal pleasure that I engage in during tax season. And having said that, though, the Earned Income Credit and all other refundable credits are very much a target of IRS audit, and so I cannot overemphasize the importance of getting the rules straight and knowing how to determine when a person can claim a particular credit. So by the end of today's session, you should know how to claim expenses for the Child Independent Care Credit, know who qualifies to take the Child Tax Credit, know who qualifies for the Earned Income Credit, know how to determine a person's eligibility for the Additional Child Tax Credit and how to calculate it, and finally, who is able to claim the Adoption Credit. So these are very important credits that we're talking about. They are big number credits. They usually amount to big savings for our clients, and we want to get those rules straight. Let's begin with the Child Independent Care Credit. Do not confuse the Child Independent Care Credit with the Child Tax Credit. Even though their names are similar, they relate to completely different items. The Child Independent Care Credit relates specifically to the cost of paying for child care. It is meant to help reduce taxes for families that pay child care or dependent care costs so that the parent or parents can go to work. The credit also applies to taxpayers who are married or have a dependent that is mentally or physically incapable of self-care. You may only claim this credit if you work or are looking for work, or if you are a student. If you are married, your spouse must also work or be a full-time student, unless he or she is physically or mentally incapable of self-care. You may only claim the credit for a qualifying person who lived with you during the year. If you separated from your spouse, you can only claim the credit if you were the custodial parent during the year. So let's just look at what's going on with this particular credit. Lots of people pay for child care as a convenience or because they want to go out for a nice evening together as a couple. That kind of child care does not qualify for the Child Independent Care Credit. The only time the Child Independent Care Credit can be claimed is when you paid for child care costs because you needed to put your child somewhere safe so that you could go to work. And so therefore, this is not a credit of convenience, but a credit of necessity. Now, in certain situations, you may have a case where you've got an unmarried couple or you have a divorced couple who have shared custody of a child and do not live together. In that case, who gets to claim the Child Independent Care Credit? Well, it would be the custodial parent. And if there's no set specified parent that is custodial, then you're going to look at the parent with whom the child spent the greatest amount of time during the year. But in the end, the credit is allowed for each child only once on the tax return of a single taxpayer, or if it's a married couple on their joint tax return. So let's look at all of the tests needed to claim this credit. And what you're going to see throughout today's lecture is that we're giving you rule after rule after rule. And some of these rules are similar to other rules we discussed when we were talking about dependency and head of household filing status earlier in our course. So we're coming back after a few weeks of missed sessions, or a few-week gap, rather, in this kind of thinking, and returning to all of these rules. So some of the rules you're going to learn today are similar to the rules we've discussed earlier in our course, but many of the rules we talk about today are subtly different. Everything's the same in the rule except 2 or 3 key points differ, and it's your job to notice when those key points are different and learn them, because you have to know them if you want to be a good tax preparer, and you have to know them if you want to pass a government competency exam. So let's begin with tests to claim the Child and Dependent Care Credit. You must meet all of the following tests to claim the credit. Number 1, the qualifying person test. You must file Form 2441 with either Form 1040 or Form 1040A. On the form, you must identify the person or persons who qualify you for the credit. You must provide the name and Social Security number or individual taxpayer identification number of each person who qualifies you for the credit. To qualify you for the credit, the person must be one of the following: your dependent who was under age 13 when the care was provided and for whom you can claim a dependency exemption. There is an exception to this rule. You are the custodial parent of your child for whom you cannot claim a dependency exemption because a divorce or separation decree or because you signed Form 8332 Release of Claim to Exemption for Child of Divorced or Separated Parents, or a similar statement in which you agreed not to claim your child's exemption for the year. So just as we had the rule earlier on in our course for head of household, that it is possible to be head of household without having a dependent, if the reason you're not claiming the dependent is you release that dependency exemption to the other parent. Under those same rules, if you're releasing the dependency exemption to your child to the non-custodial parent, but you have qualifying child care expenses, you can still claim those expenses even though you're not claiming your child's exemption. I also wanted to point out here about the rule about your child being under age 13 when the care was provided. It is not stating that the child must be under age 13 at the end of the year, as is often the case with many other rules. In this case, a child who turned 13 during the year can have qualifying expenses for the period of the year or the part of the year that they were still under age 13. The next type of individual who can qualify you for the credit is your spouse who was physically or mentally not able to care for himself or herself and lived with you for more than half the year. So generally, we think of the Child and Dependent Care Credit as applying to people who have children, but it could be the case that the person you are caring for or providing care for is your spouse. And if you're providing the care because your spouse cannot care for themselves, then that is an allowed expense. Also, your dependent who is physically or mentally incapable of self-care and for whom you claim a dependency exemption or could claim except that individual had gross income of $3,650 or more. So what they're essentially saying is you could have a child or other dependent who is age 13 or older but is not mentally capable of caring for themselves, and you are therefore forced to provide child care for them so that you can go to work. That is a situation where you can still claim the credit. And in addition to that, even if you can't claim their dependency exemption, you can still claim credit if the only reason you can't claim the exemption is because their income was too high. Let's look at the second rule. So the first rule was you have to have a qualifying person. The second rule is that you have to be keeping up a home. You and your spouse, if married, must pay more than half the cost of keeping up a home for the year in which you live with the qualifying persons. The cost of keeping up a home includes the cost of rent, mortgage interest, property taxes, utilities, repairs, home insurance, and food eaten in the home. Yes, all of these are examples of the cost of keeping up a home. But the cost of keeping up a home does not include the cost of clothing, education, medical care, transportation, vacations, life insurance, the cost of purchasing, improving, or replacing property, including your home. Now, these costs are costs associated with paying for the support of a dependent, but the cost of supporting a dependent is different than the cost of supporting a household. And the rules for the Child and Dependent Care Credit say you must pay more than half the cost of keeping up a home in which you live with a qualifying person. Earned income test. You and your spouse, unless either of you were physically or mentally incapable of self-care, or either of you were students, must have earned income during the year. For purposes of this test, earned income includes wages, salaries, tips, and other employee compensation. It also includes self-employment income, but a net self-employment loss will decrease the amount of earned income that you have. Also, non-taxable earned income such as parsonage allowances, meals and lodging furnished for the convenience of the employer, voluntary salary deferrals, and military basic quarters and combat pay are all treated as earned income for purposes of this test. But earned income does not include Social Security, pensions, annuities, investment income, scholarship income, unemployment, or workers' compensation. There is a special rule that you should be aware of for a student or disabled spouse. Your spouse is considered to have earned income for any months that he or she was a full-time student or was physically or mentally incapable of self-care. Your spouse must also live with you for more than half the year to meet this rule. What we're getting at is that the preceding rule, earned income, says that you and your spouse have to have earned income. That means you must work and have income, and your spouse must work and also have income. If your spouse doesn't work, your spouse can be treated as if they had income if they were a full-time student or if they were physically or mentally incapable of caring for themselves. Next rule is rule number 4, work-related expense test. You must pay the child and dependent care costs to enable you to work for pay or to look for work. If you did not work for the entire year, you must include only expenses you paid while you were working or looking for work. Payments to relatives. You must make payments for child and dependent care to someone you cannot claim as a dependent. If you pay your non-dependent child for the care, the child must be age 19 or older by the end of the year. Filing status. You cannot claim the credit if your filing status is married filing separately. All other filing statuses are eligible to claim the credit. Provider identification. You must identify the person or business you pay to provide care. You must provide the following information for each provider: the name, address, and Social Security number or employer identification number. There is a due diligence requirement, and it states that you must use due diligence to obtain provider identification. If you try to obtain provider information and cannot because the provider refuses, and that's not uncommon at all, you should report whatever information you have on page 1 of your Form 2441. Enter "See attached statements" in the columns calling for information that you do not have. Attach the statement explaining that you requested the information but that the provider did not give it to you. Write your name and Social Security number on the statement. That statement is considered to be due diligence. So what this is about is that you may have paid for your child to go to a child care provider. Perhaps it's a child care provider working out of their home. And perhaps this person who's providing the child care does not want to report the income on their tax return, or perhaps this person is in the country illegally and is not authorized to work. Those are two common reasons why a child care provider will refuse to provide their identifying number. And whether their provider is in the country legally or not, they are still supposed to provide you with a receipt and an identification number. And the IRS has the ITIN application process, which we did talk about in session 1 of this course, where a person who is not eligible for a Social Security number can apply for one through the ITIN application on Form W7. So if your client has child care being provided by a person who does not have a Social Security number, you could provide them with the Form W7 to take to that provider and ask the provider to apply for a number. Now, of course, the provider will have to file a tax return and attach the application to a tax return, and maybe they don't want to. Maybe they're going to refuse. Well, that would be a situation where you've made a due diligence effort to obtain the information, and that information has been refused. That would be a reason to attach a statement to the return and an explanation of what efforts you made to obtain the number that were unsuccessful. Now, the other side of the equation is sometimes you are paying for child care to a person who is in the United States legally, but they just don't want to report the income. In other words, they're tax cheats, and they don't think they should have to report that income on their tax return, and they know that if they give you their number, then maybe they're going to have to, and so they're refusing to for that reason. And basically, a person or individual who does not want to comply with federal tax laws is not your problem. That would be another reason to write and attach a statement to your return. So I try not to express my opinion too much in this course about too many things, but this is one thing I really do have to express an opinion on, and it's a little bit of a fiery opinion. I'm a taxpayer, and I'm sure most of you who are participating in this course are also taxpayers. And we look at our government and the deficit that it's in, and the efforts that the government is perhaps going to be making to raise income tax on middle-class workers. And why is it doing that? Well, it's doing that because too many people are not paying enough. Some people are not paying enough simply because the tax code is just giving away too many deductions. But others are not paying enough because they're cheating and they're not filing and paying taxes on their income. So if you feel that that's okay and you just want to give up a deduction and let that person not pay their fair share, that's obviously your decision. But I have a different opinion on that, and I always get pretty fiery when my clients start saying, well, they don't want to report that income on their tax return, so I'm just going to let them go on that. And I say, well, of course, that's your priority. You do not have to claim this credit if you do not want to. But did you know you are paying extra taxes because they're not paying their own fair share? So that's the opinion I have, and you can share it or oppose it. It's a free nation. We're allowed to have our free opinions. Moving on, not question number 8, but rule number 8. That is the employer-paid expenses test. You must reduce your credit by any amount of dependent care expenses that your employer paid for you or which you had withheld from your income tax-free. And here we are already on our first password of the day. The password to open the Session 9 quiz answer key is rebellion, R-E-B-E-L-L-I-O-N. Dependent care benefits include the amounts your employer pays for your qualifying person or the fair market value of free care you receive in a daycare provided by your employer. Your salary may have been reduced to show these benefits. If you received these benefits, they should be reported in Box 10 of the Form W-2 that you receive. There is an earned income limit that you should be aware of. The amount of work-related expense that you claim cannot be more than your earned income for the year if you are single or considered unmarried at the end of the year, or the smaller of you or your spouse's earned income for the year if you are married at the end of the year. Now, each month in which your spouse was a student or was incapable of self-care is a month in which your spouse is treated as having earned income. Your spouse is considered to have earned income of $250 for each month if there is one qualifying person, or $500 a month if there are 2 or more qualifying persons. So for example, if you wish to claim the child and dependent care credit for 2 qualifying individuals, and you have a spouse who is a full-time student for 9 months out of the year, then you would be able to claim $500 times 9 months, or $4,500 of qualifying earned income for purposes of this earned income limit. Next up is the dollar limit. The maximum amount of dependent care expenses you can claim for the credit is $3,000 for one qualifying person or $6,000 for 2 or more qualifying persons. How do you calculate the credit? Well, you need to complete Form 2441 to calculate your credit. Your credit is a percentage of your allowable expenses, and the percentage of allowable expenses you can claim varies from 35% down to a low of 20%, depending on your adjusted gross income. Maximum credit of 20% is reached when your adjusted gross income reaches $43,000 or more. So in other words, the smallest credit you're ever entitled to would be 20% of your qualifying expenses, of up to $3,000 for one qualifying individual or up to $6,000 for 2 or more qualifying individuals. Thus, the smallest credit, if you had $6,000 of expenses for 2 qualifying individuals, would be 20% of $6,000 or $1,200. And the largest credit you receive could be as much as 35% of up to $6,000. I very rarely see people getting the 35% rate, simply because people who are entitled to a 35% rate generally have income that is low enough, they're not paying tax or they have no tax liability. And of course, as we have already taught you in our last session, you can only claim a credit if you have a tax liability, and if you don't have a tax liability, then the credit is lost. So this 35% limit really applies to very few people, and the reason for that is this is another example of thresholds or limits that have been set in place over time but are never adjusted for inflation. So the phase-outs on each percentage rate over time have never changed, and therefore the point at which your credit is reduced to only 20% of your adjusted gross income at $43,000 has not changed in the last 20 years. And of course, $43,000 today is a lot less money than $43,000 was 20 years ago. Now, to claim the credit, complete Form 2441 and enter the credit on Form 1040, line 48, or on Form 1040A, line 29. So here is our Form 1040, and the point at which you enter the Child Independent Care Credit on page 2 is right here, line 48, Credit for Child Independent Care Expenses, attached Form 2441. Now, again, the credit is limited to your tax. The Child Independent Care Credit is non-refundable. This means it can reduce your tax to zero, but if your credit is greater than your tax, the difference cannot be refunded to you. So very often on line 48, I will see people either not claim a credit at all because they have zero tax on line 46, or they will get a partial credit on line 48 because their tax on line 46 is a small enough number that they're not able to benefit in full from the Child Independent Care Credit. There is no carry-forward provision on the credit. Now, I have up in front of you the form itself, Form 2441, and you will see in Part 1 you are asked to provide information about the persons or organizations who provided the care. You would enter the name, the address, the Social Security number or employer identification number, and the amount that you paid to that provider. Then in the second section down here, it provides space for entering information about the child or the dependent for whom the Child Independent Care expenses are being provided. That is your qualifying person on line 2. So we would enter the first name, the last name, the qualifying person's Social Security number, and the expenses paid for the care of that person. On line 3, you enter the total amount that was spent on the care of the qualifying persons minus any amount that was shown on Form W-2, Box 10. But on line 3, do not enter more than $3,000 for one qualifying person or $6,000 for two or more qualifying persons. Here are the decimal amounts I was referring to, and you can see that $43,000 is the point at which you reduce yourself down to a maximum credit of 20% of the qualifying expense. And your income must be between $0 and $15,000 to qualify at the 35% rate. Well, as if we were just to do a particular math computation over here on line 38, and I'm going to do that just now to make a point. So here I've taken this particular table amount of $15,000 of income and entered that as the adjusted gross income on the tax return for this scenario. And of course, you must pay more than half the cost of keeping up a home to qualify for the Child Independent Care Credit. That would cause me to conclude that if you're single, you would need to be head of household, and so your standard deduction would be $8,400. We subtract 84 from 15,000, we get 6,600, and then it stands to reason you would also be claiming a dependency exemption, one for yourself and for at least one qualifying person, correct, who is your dependent in most cases, and that would be $7,300. By the time you subtracted out $7,300, you can see that the taxable income is down to zero, and if your tax is zero, then you wouldn't be able to claim the credit. So although it is theoretically possible to have $15,000 of income and qualify for the Child Independent Care Credit without having a dependent, for example, that dependent is being claimed by the non-custodial parent, that is a relatively rare situation. And so as you can see from this point, that very few people would qualify ever for this maximum percentage of 35% and even begin to benefit from it. Most filers fall either at the 20% level or at somewhere in income ranges between $29,000 and $43,000 would be getting one of the percentages in here. So, of course, you use the appropriate decimal amount based on your adjusted gross income showing on your federal return to calculate the federal credit. You multiply your decimal amount by the allowed expenses that are showing up here on line 3. So if the allowed expense on line 3 is $4,000 because you have two or more qualifying children and that's your total expense, then you would go $4,000 times your applicable percentage. And let's just suppose that applicable percentage is 24%. Well, then you would go $4,000 times 24% equals $960, and that would be the credit that you enter on the line. Line 9 is the qualifying expense multiplied by the decimal amount. Then on line 10, you are asked to enter the liability limit. And the liability limit would be your tax on line 46 minus the foreign tax credit. So you would have to subtract the foreign tax credit and then look at the amount of tax you still have less. The amount on line 48 cannot be more than line 46 minus line 47. So you'd have to be able to show that line 10 was at least $960 in order for you to claim $960 of credit. And if line 10 is only $800, for example, then the amount that you would enter on line 11 would not be $960, but would instead be $800. All right, moving on. We have part 2, or it's actually part 3, of the Child Independent Care Credit Form 2441. Part 3 appears on page 2 of the form, and you only need to complete Part 3 if you receive dependent care benefits at work. So most filers do not receive dependent care benefits at work, and therefore most filers do not complete Part 3 or page 2 of Form 2441. But if you do have a client who has dependent care benefits showing in Box 10 of their Form W-2, then you do need to complete Part 3. You would enter the amount of benefits shown in Box 10 of the W-2 on line 12. Then on line 16, you enter the total qualified expenses that were paid. If the amount on line 12 is less than or equal to the amount on line 16, none of your benefits are taxable. Finish completing Form 2441 and claim any dependent care credit you are entitled to on Form 1040, line 48. But if your dependent care expenses are less than your benefits, you would enter the difference on line 26, and whatever amount you enter on line 26 would become income to you. So let's look at an illustration of how all of this would work. Holly Hobby was issued the following W-2 form showing dependent care benefits of $5,000 in Box 10. Her qualified expenses for the year, however, were only $4,800. So since her qualified expenses were less than her benefits, she will need to add $200 of forfeited expenses to her income. So these are instructions on how her form would fill out, and I will fill that out for you just now. So here's how these numbers would transfer over to Part 3 of Form 4562 for Holly Hobby. We can see that we begin by entering the amount of dependent care benefits that were reported on her W-2 in Box 10. That's $5,000. There are 2 lines devoted to topics such as what was your carryover of expenses from the prior year, or what is the amount, if any, of forfeited expenses carried forward to 2011, and provides instructions on that. Neither of those situations applies to Holly Hobby, so we again enter $5,000 on line 15. Then it says on line 16, enter the total amount of qualified expenses you had for the year, and in the case of Holly Hobby, that was $4,800. We then enter the smaller of her qualified expenses or the dependent care benefits that she received, and the qualified expenses is the smaller number, so we enter that. Next, we're applying the earned income limit. We need to show that Holly Hobby has at least enough earned income for the year to qualify for the dependent care benefits she received. Her earned income is $25,000. It is more than enough, so she is fine there. Then it says enter $5,000 or half that amount if you are filing separately. $5,000 is the highest amount of salary deferral you are allowed to have for child independent care expenses, so there should never be more than $5,000 in Box 10 of a person's W-2. Holly Hobby enters $5,000 because she is single, and then we enter the amount of deductible benefits that she has received for the year. Well, her deductible benefits are equal to the qualified expenses she had, but not greater than the $5,000 that was excluded from her pay. And in this case, the qualified expense is $4,800. And then we continue with the math, and in the end we are left with $200 of taxable benefits. And how is that treated on the tax return? Well, we would go over to Holly Hobby's personal return, and on Form 1040, line 7, where we enter wage income, we would enter the code DCB, meaning dependent care benefit, and $200. That $200 adds to the $25,000 showing on her W-2. And so $200 plus $25,000 is $25,200 of taxable income being reported on line 7 of her tax return. The next topic of the day is the child tax credit. The child tax credit is claimed on line 51 of the Form 1040. We've been working with this credit for most of the course. For 2010, this credit is $1,000 for each qualifying child. You claim the credit on line 51 of Form 1040 or line 33 of Form 1040A. A qualifying child for the child tax credit is all of the following: Your son, daughter, stepchild, foster child, brother, sister, stepbrother, stepsister, or a descendant of any of them, that is your grandchild, niece, or nephew, for example. Also, this person must have been under age 17 at the end of the year, must not have provided more than one-half of his or her own support, must have lived with you for more than half of the year, must be claimed as a dependent on your tax return, and is a U.S. citizen, U.S. national, or a U.S. resident alien. There are tax limits on the child tax credit. The maximum child tax credit you can claim is the lesser of your federal tax liability after certain credits, or $1,000 for each qualifying child. If your credit is limited because your tax is less than the credit, you may qualify for the refundable additional child tax credit, which we will describe later. Income limits on the child tax credit. If your modified adjusted gross income is above the amount shown below for your filing status, your child tax credit will be reduced or eliminated. And you can see here that married filing jointly, that limit is $110,000. Single head of household or qualifying widower is $75,000, and married filing separately, that limit is $55,000. These are actually pretty low limits. They are intended really, the intention really is for this credit to benefit only middle income filers and lower income filers. Anyone who is beginning to move into the upper middle income brackets is phased out. And if you live in a higher income area like California or the city of Portland or Seattle or New York, for example, you will find that a great percentage of your clients may phase out on this credit, but there's still plenty of people out there with incomes that fall into these ranges, and by sure, the vast majority of filers with children under the age of 17 do actually benefit from this credit. And this really is a fantastic credit that produces some very significant savings for taxpayers. Let's look at the definition of modified adjusted gross income. For purposes of the child tax credit, your modified AGI is your adjusted gross income plus the following amounts that may apply to you. Any amount you excluded from income because of the exclusion of income from Puerto Rico. Any amount on line 45 or line 50 of Form 2555. And any amount on line 15 of Form 4563, exclusion of income for bona fide residents of American Samoa. So essentially, if you were able to reduce your income because you were able to exclude your income under any of these three situations, then you're going to have to add that income back in for purposes of calculating your adjusted gross income. But of course, most people don't have those issues applying, and so therefore the amount shown on line 38 of your tax return is very likely your income for the year for purposes of the phase-outs. If your adjusted gross income is above the amount shown for your filing status, complete the child tax credit worksheet to compute your allowable credit. Here is the worksheet, and you will see that it begins by asking you in Part 1 to enter the number of children you have who are qualifying children under the age of 17, and then multiply the number of children you have by $1,000 and enter the total on line 1. You then enter the amount of adjusted gross income you have and see if you're affected by any phase-out. You enter the amount shown below for your filing status, and let's just suppose your filing status is single. You would then enter $75,000 on line 5. And the question is your adjusted gross income on line 4 more than the amount on line 5? If it is, you are subject to a phase-out. If it is not, you are not subject to a phase-out. But let's suppose that you are subject to a phase-out because you had income of $80,000. Then let's see what would happen here. So I've dummied up some numbers on the form just so you can see the purpose of it and how it works. We begin on line 1 by entering the amount of credit multiplied by the number of children. In this case, I just decided to make it one child, therefore $1,000 is entered on line 1. The next step is to enter your adjusted gross income, and I said that that would be $80,000. Then we enter the threshold phase-out range for your filing status, which in this case is $75,000 for a single person. We subtract that income phase-out from the amount of income there is, and we're left with $500. We multiply that by 5% and enter the amount on line 7, $250. So 5,000 times 5% is $250. We subtract $250 from $1,000, and that leaves us with a $750 allowable credit. Now the next part of the form, Part 2, is to determine if our child tax credit is going to be reduced by any other credits we're entitled to claim and did in fact claim on the 1040 form. And so in our last class I pointed out to you that these credits typically are claimed in the order in which they appear on the form, the exception being the child tax credit where the tax credit is actually not claimed in the order that it appears on the form. And you will see why here. In Part 2, we'll see that the credits that are used first include the foreign tax credit, the child and dependent care credit. So it's correlating those to the line of the tax return, line 47 being the foreign tax credit line, line 48 being the child and dependent care line, line 49 being the education credit line, line 50 being the retirement savings credit line, and then we have 4 different lines all devoted to different types of energy credits. There's the residential energy credit, the alternative motor vehicle credit, the electric car credit, and finally we also have the credit for the elderly and disabled. All of these credits take priority and will be used up first, and then we continue on down the form and we can see, are you claiming any of these credits, the mortgage interest credit, the residential energy efficient property credit, or the first-time homebuyer credit for the District of Columbia. So again, we have even more credits here that take priority, and if you have any of these credits, those credits are subtracted from your tax first, and your final allowed child and dependent care credit that you would enter on line 51 is going to be your tax on line 46 minus all of the other credits mentioned on this form. And if your tax is still greater than 0, then you apply the child tax credit up until the level of your tax, but never more than your net tax after subtracting out all of these other credits. The next credit in line is to talk about the earned income credit. The earned income credit is, of course, a refundable credit. And as I already told you, it's just one of my favorite credits and has been for all my years in taxes. The earned income credit is claimed on line 64 of 1040. And the earned income credit is a refundable credit that is designed to help working low-income families and individuals. Now, over the years, I as an instructor have received criticism from more than one student because I use the word low income, and some people are offended by that terminology. I'm not the person that invented that word. It is the tax code itself and our government that has identified and set parameters by which a particular income group is considered to be low income under the law. And this particular credit, as well as other credits, are specifically targeted to benefit groups that are considered to be low income. One of the definitions of low income is to look at the federal poverty level for the neighborhood or area that you live in or for the country as a whole. And very often you are considered low income until your income is twice the federal poverty limit. But that is not necessarily the only definition that applies. I just wanted to point out that it is not me that comes up with these terms, and when I am using them to describe the law and the individuals that they are intended to target. Now, earned income defined. The term earned income means you must have worked during the year to be eligible to receive the credit. Earned income can come from wages, self-employment, or active participation in a partnership. Taxable earned income. Earned income can be paid in the form of taxable wages, salaries, and tips, or in your net earnings from self-employment. Now, here we're getting into the rules. Of course, the first rule about the earned income credit is that you have to have earned income because the credit itself is targeting working families, particularly families with children. The intention of the earned income credit from its very beginning has been to help keep working families above the poverty level. And there are 2 ways politically that this can happen. And the United States government has chosen to use the earned income credit. The other methodology by which individuals can have their incomes raised is, of course, to raise the minimum wage. And in many first world countries throughout the world, for example, Australia and Canada and most European nations, the minimum wage is actually much higher than it is here in the United States. And those foreign countries also provide many other benefits, public assistance benefits to families with children. For example, in Canada, where I grew up, they have something called family allowance. And when a mother has a child, until that child reaches a certain age, the Canadian government gives her a monthly check. It comes every month, and it's used to help her support that child. Well, we don't have a program like that in the United States other than welfare. and the Earned Income Credit. And so the Earned Income Credit is the methodology by which the federal government is providing benefits to working families, particularly families with children. But the requirement is that you be working and that you have earned income and that your income is below a certain amount based on your filing status and the number of children you have. So let's look at the rules. Firstly, the rules for taxpayers who do not have a qualifying child. Now, although the Earned Income Credit was originally targeted at people who have children, it was expanded more than a decade ago to include individuals who do not have children. Of course, the rules for individuals who do not have children really focus on income, and the income has to be very low. Your total earned income as well as your adjusted gross income must be less than $13,460 or $5,000 more if you are married filing a joint return. Also, you must be at least age 25 and under age 65. I take that to mean that you have to essentially be beyond the age where most people might be attending college or still be dependents of their parents, but they must be under the age where they are eligible for Social Security benefits. You cannot be the dependent or qualifying child of another person. You must have lived in the United States for more than half the year. You and your spouse, if filing jointly, must have a valid Social Security number. Your filing status cannot be married filing separately. You must have been a U.S. citizen or resident alien for the entire year. You cannot file Form 2555 or Form 2555EZ relating to foreign earned income exclusion, and your investment income must be $3,100 or less. And, of course, you must have earned income. So those are the rules that apply to taxpayers without qualifying children. And I want to go back to this rule about age and specifically point out that this age rule applies only when you do not have a qualifying child. If you do have a qualifying child, you ignore all of these rules completely and move down to the rules for taxpayers who do have qualifying children. And the first rule there is that your total earned income as well as your adjusted gross income must be less than $35,535 if you have one qualifying child, or less than $40,363 if you have two or more qualifying children, or less than $43,352 if you have three or more qualifying children. And I should point out that each of those income amounts goes up by $5,000 if your filing status is married filing joint. Your child must meet the relationship age, residency, and joint return tests. And your qualifying child cannot be used by more than one person to claim the Earned Income Credit. You cannot be the qualifying child of another person. You, your spouse, if married filing joint, and your qualifying child must all have valid Social Security numbers. Your filing status cannot be married filing separately. You must have been a U.S. citizen or resident alien all year. You cannot file Form 2555 to exclude foreign earned income. Your investment income must be $3,100 or less. And, of course, you must have earned income. Now, you will see that some of the rules for people with a qualifying child are the same as some of the rules for people who do not have a qualifying child. But you should still only look at the situation directly. Is this a person who has a qualifying child, or is this a person who does not have a qualifying child, and apply the rules as they are appropriate. Now let's look at each of these tests in turn so that we understand them more clearly. The first test we're looking at is the relationship test. Your child must be your son, daughter, stepchild, adopted child, eligible foster child, or descendant of any of them. For example, a grandchild. Or they must be your brother, sister, stepsister, half-brother, half-sister, or descendant of any of them. For example, a niece or nephew. Note that an eligible foster child must have been placed with you by an authorized agency. For purposes of the Earned Income Credit, this particular requirement has been in effect every year since 2002, so this is not a new rule. It's been around for close to a decade now. Age test. Your child must be under age 19, under age 24 at the end of the 2010, a student, and younger than you or your spouse if you were filing jointly, or must have been permanently and totally disabled at any time during the year, regardless of their age. Student defined. To qualify as a student, Your child must be during some part of each of any 5 calendar months during the year a full-time student at a school that has a regular teaching staff, course of study, and a regular student body at the school, or a student taking a full-time on-farm training course given by a school described in one above, or a state, county, or local government. The 5 calendar months do not need to be consecutive. So let's just think that what might go on with a particular person is being defined as a student. Let's suppose you have a child that turned 19 during the year, and 19 is the year they graduated from high school. Well, they would have attended, presumably, high school in January, February, March, April, and June. That's the way it is in most states of this country, although you might have a split year where it could be that the year finishes at some other time. But what the IRS is saying is if you can show that the child went for a few weeks in each of those months, and during the time they were in school they were considered full-time by that school, then they will have met the test. Or alternatively, maybe your child attended 3 months of college in January, February, March, and then took a hiatus and didn't attend college again until the fall, where they picked up and attended 3 more months in the fall. That combined would be full-time, as long as, of course, the time they were in school, they were attending full-time. So a full-time student is a student who is enrolled for the number of hours or courses that the school considers to be full-time attendance. Joint return test. To meet this test, the child cannot file a joint return for the year. There is an exception to the joint return test, and it applies if your child and his or her spouse file a joint return only as a claim for refund. So that's the same test that applies when we're looking at the qualifying child test for joint return rules. Residency test. Your child must have lived with you in the U.S. for more than 6 months during 2010. United States. This means the 50 states and the District of Columbia. It does not include Puerto Rico or a U.S. possession such as Guam. Homeless shelter. Your home can be located anywhere where you regularly live, and you do not need a traditional home. For example, if your child lives with you for more than half the year in one or more homeless shelters, your child meets the residency test. Military personnel stationed outside of the United States. U.S. military personnel stationed outside of the United States on extended active duty are considered to have lived inside the United States during that duty period for purposes of the Earned Income Credit. Birth or death of child. A child who was born during 2010 is treated as having lived with you for all of 2010 if your home was that child's home the entire time he or she was alive during the year. Temporary absences. Count the time that you or your child is away from home on a temporary absence due to special circumstances as time that the child lived with you. Examples of special circumstances include illness, school attendance, business, vacation, military service, and detention in a juvenile facility. So let's suppose you have a 21-year-old child who goes away to college. They're at college, living in student housing, and each Christmas and summer they come home and live with you. Well, the time they're spending away at college is considered to have been time spent with you, if while they're not attending college they are with you. But on the other hand, if you have a child who essentially leaves homes, take up their own space in college, they get a job, they're working their way through college, and they don't come home at all after that and basically say, goodbye, Mom, goodbye, Dad, then that would be an example of someone who is not away on a temporary basis. It would be permanent. So you have to look at the facts and circumstances and decide what applies to you. If the child's absence is temporary, and by that we mean that they intend to come home at the end of the absence, then we would say that it is temporary. But if they leave and they do not intend to return, then it would not be temporary. Kidnapped child. A kidnapped child is treated as living with you for more than half of the year if the child lived with you for more than half of the part of the year before the date of the kidnapping. The child must be presumed by law enforcement authorities to have been kidnapped by someone who is not a member of your family or the child's family. This treatment applies for all years until the child is returned. However, the last year this treatment can apply is the earlier of the year there was a determination that the child is dead, or the year in which the child would have reached age 18. If your qualifying child has been kidnapped and meets these requirements, enter KC, as in kidnapped child, instead of a number on line 6 of Schedule EIC. And line 6 is where you enter the number of months at home. Valid Social Security card. Unless your child was born and died during the year, you and your spouse, if filing a joint return, and your child must all have valid Social Security numbers. You cannot claim the Earned Income Credit if you or your spouse or your qualifying child's Social Security number is missing or incorrect on your tax return. You or your spouse, if filing a joint return, or your qualifying child's Social Security number says not valid for employment and was issued only for use in getting a federally funded benefit, or you or your spouse are filing jointly, or your child has an ITIN or an Adoption Identification Number, ATIN. And just as a pointer, all ITINs begin with a digit 9, so if you've been presented with a Social Security number that begins with a 9, your warning bell should be going wing, 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 wing. This person probably will not qualify for the Earned Income Credit, and in fact your tax software will probably tell you they don't qualify in its warnings note somewhere. So what happens if your qualifying child is also the qualifying child of another person? Well, understandably, the rule is that your qualifying child cannot be used by more than one person to claim the EIC. So if 2 or more people qualify to claim the same child, only one person can actually claim that child. If you can agree between you who will claim the child, then you can split the child as you agree. But if a parent can claim the child as a qualifying child and no parent decides to claim the child, then the child is treated as the qualifying child of the person who had the highest adjusted gross income for the year, but only if that person's adjusted gross income is higher than the highest adjusted gross income of any of the child's parents who could claim the child. So let's look at what we're talking about here. Let's suppose we've got grandma and the mother of the child and the child all living together in the same household. Father is off, we don't know where he is. So we've got grandma, we've got mama, and we've got baby in the house. And grandma's income is $30,000 and the mother's income is $20,000. Mother can make a decision to let grandmother claim the child if she chooses to. But she can only choose to do so because grandma's income is higher than hers. If grandma's income turns out to be $19,000 and mother's income is $20,000, mother cannot make that election to have the grandmother claim the child. In other words, the grandmother would not be allowed to claim the child because the grandmother's income is not higher than the income of the mother of the child. Now, if the mother and the father are out of the picture completely, and you've got 2 people living together in the house, one of whom is the grandmother, then that grandmother will be able to claim the child regardless of what the parent's income is, because the parents aren't entitled to claim that child anyway. Now, if the child's parents file a joint return with each other, this particular rule can be applied by treating the parents' total AGI as divided evenly between them. You can decide who will claim the child, or if you both cannot agree who will claim the child, the following tiebreaker rules shall determine who will claim the child. Under the tiebreaker rule, the child can be treated as the qualifying child only by the parent if only one of the persons is the child's parent. The parent with whom the child lived for the longest period of time during the year, if 2 of the persons are the parents of the child, or the parent with the highest adjusted gross income if the child lived with each parent the same amount of time during the year, the highest adjusted gross income, or the person with the highest adjusted gross income if none of the persons is that child's parent. Now, under the tiebreaker rules, the qualifying person who claims the child for the Earned Income Credit must also be the same person who claims the child for all of the following, including the exemption deduction, the child tax credit, the head of household filing status, the credit for child and dependent care expenses, and the exclusion of dependent care benefits on Form W-2. There is an exception to this rule, and it's the same exception we see time and again, and that is that if the non-custodial parent is entitled to the child's dependency exemption, the child may be claimed for the child tax credit and the dependency on the non-custodial parent's return, and will be still eligible for all other benefits on the return of the custodial parent. So let's just suppose you are the custodial parent, but you are not claiming your child's exemption because the non-custodial parent is entitled to that exemption. Then you would not claim an exemption deduction for your child, and you would not claim the child tax credit. But you still could be head of household. You could still claim the child and dependent care credit. You could still be eligible for the exclusion of dependent care benefits, and you could still be eligible for the Earned Income Credit. So it's feasibly possible to have a tax return that looks like this. I'm going to go over and I'm going to enter a taxpayer who is single. She does not even need to be head of household to qualify for the Earned Income Credit. So we could have a situation where we've entered a filer as single. On line 1, we have no dependency exemption entered under dependents, and when we get over to page 2, it is still possible to have that individual qualify for the Earned Income Credit. Remember, the rules for head of household are different than the rules for claiming dependents. They're different than the rules for the Child and Dependent Care Credit, and they are different than the rules for the Earned Income Credit. It is conceivably possible to qualify for Earned Income Credit when you do not qualify for head of household and you do not have a dependent. Now, a summary of who qualifies for the Earned Income Credit. To qualify for the credit, you must meet all of the following rules. You must have a valid Social Security number. If your Social Security card says not valid for employment and you were issued the card so that you could get a federally funded benefit such as Medicare, you do not qualify for the Earned Income Credit. Your filing status cannot be married filing separately, but it can be single, head of household, married filing joint, or qualifying widow. You must have been a U.S. citizen or resident alien all year. You must have lived in the United States for more than half of the year if you do not have a qualifying child. If you do have a qualifying child, then that child must have lived with you in the United States for more than half the year. You cannot file Form 2555 or Form 2555-EZ. Your investment income must be $3,100 or less, and you must have earned income. The next password we have for the day is the password to open the Session 10 homework answer key, and that password is Hilo, H-I-L-O. That's the city of Hilo on the big island of Hawaii. And here's a table straight out of Pub 17. The Earned Income Credit in a nutshell, and anytime you have any questions about whether or not your client qualifies for the Earned Income Credit, I suggest you whip open Pub 17 and flip to this table, because it does a very nice job of breaking down the rules for you. You will see it says in Part A, rules that apply to everyone. We then have rules in Part B that apply if you have a qualifying child, or rules that apply in Part C if you do not have a qualifying child, and then third, rules that apply to everyone. And you will see that Part A and Part D apply to all filers, but if you do not have a qualifying child, you'd go to column Part C, and if you do have a qualifying child, you would go to Part B, and you would never apply both these columns to a filer. So let's look at Part A first, rules that apply to everyone. Your adjusted gross income must be less than the amount shown for your filing status and the number of qualifying children you have. You must also have a valid Social Security number. Your filing status cannot be married filing separately. You must be a U.S. citizen or a resident alien. You cannot exclude your foreign income. Your investment income must be $3,100 or less, and you must have earned income. Now, if you have a qualifying child, your child must meet the relationship, age, residency, and joint return tests. Your qualifying child cannot be used by more than one person to claim the Earned Income Credit, and you cannot be a qualifying child of another person. If you do not have a qualifying child, then you must look to your age. You must be at least age 25, but not under age 65. This age rule is not here in the column if you have a child. It is only in the column where you don't have a child. You cannot be the dependent of another person, you cannot be the qualifying child of another person, and you must have lived in the United States for more than half the year. And finally, Part D, rules used to calculate the credit and claim the credit. You have to have earned income, and it has to be less than the amount shown. You will see that the earned income amounts are the same as the adjusted gross income amounts, but essentially there's two tests. You look to your adjusted gross income, it cannot be more than these amounts, and then you look to your earned income, and your earned income also cannot be more than these amounts. So how do you claim the Earned Income Credit? Well, if you do not have a qualifying child, you figure your Earned Income Credit using the EIC worksheets and tables. You then enter your allowable EIC on Form 1040, line 64A, or on Form 1040A, line 41A, or even on Form 1040EZ, line 9A. But if you do have a qualifying child, you need to figure your earned income credit using the Earned Income Credit worksheets and tables. You then must complete Schedule EIC for Form 1040 or 1040A and attach it to your tax return. And then you must enter your allowable EIC on Form 1040 line 64A or on Form 1040A line 41A. Now, Schedule EIC must be attached for a qualifying child. The Schedule EIC must be completed if you are claiming earned income credit for one or more qualifying children, and space is provided on the form for up to 3 children. Now, I should point out that tax software typically will enter children on Schedule EIC in the order of their age, with the youngest child appearing first. Now, it used to be many, many years ago that it was actually in the IRS instructions for Schedule EIC to enter the youngest child's name first. I haven't seen that rule in print for a long time, but it is a rule that the tax software companies, at least the ones we use, are still following. So when you're entering children in the tax software, you might just be entering them randomly in the order that you have the card in front of you. And whatever order you enter them into in the tax software is the order that they will typically appear in on the 1040 form. So if you're listing dependents, they'll usually appear here on the dependency lines in the order in which you entered them into the software. But when it comes to the earned income credit, the software will typically order the children on the Schedule EIC by order of their age, with the youngest child appearing first. And here we have Schedule EIC, and this is where I'm saying if you have 3 children, the tax software will typically enter the youngest child first, the second youngest child second, and the third youngest child third. And if you had a family, say, with 4 children, all of whom qualify for the earned income credit, you would list the youngest 3 children on here. Again, I no longer see those instructions appearing anywhere in the instructions for Form Schedule EIC. However, tax software still files it, and those of us like me who have been at it long enough still tend to apply that rule. Next rule, line 2, enter the child's Social Security number. The child must have a valid Social Security number, except in situations where the child died during the year, and then you would need to attach a copy of the birth certificate as well, and of the death certificate or other hospital medical records. Child's year of birth, enter the year that the child was born. If the child was born after 1991 and the child was younger than you or your spouse, if you are filing jointly, you do not need to complete lines 4A or 4B. You simply go down to line 5 and enter your child's relationship. On line 6, it says to enter the number of months that your child lived with you in the United States. If your child was kidnapped, you would write KC in this space instead. And what is line 4A and 4B about? Well, if the child was not born after 1991, that means the child is age 19 or older. And if the child was age 19 or older, they needed to have been either a full-time student or disabled during the year. So you will need to answer yes to either of these 2 questions for a child that was born before 1991. Form 8862 is required in 2010 in certain situations. If you qualify to claim the earned income credit by meeting all of the rules that we just described in Publication 17 or 596, and your earned income credit for any year after 1996 was denied or reduced for any reason other than a math or clerical error, you must attach a completed Form 8862 to your next tax return to claim the EIC. However, do not file Form 8862 if either 1 or 2 below is true. Number 1. After your earned income credit was reduced or disallowed in the earlier year, you filed Form 8862 in a later year, and your EIC for that later year was allowed, and your EIC has not been reduced or disallowed again for any reason other than a math or clerical error. So what this is saying is if you file for earned income credit in an earlier year and the IRS determines that you shouldn't have applied for the credit and you should have known you weren't eligible and you basically recklessly did it anyway, that they will deny that earned income credit to you in that year, and they will also deny it to you in subsequent years. Now, if you want to apply for the credit again in a future year, you have to do so with Form 8862 attached. IRS says that once you've attached 8862 to your tax return and subsequently you have been allowed to claim the credit, then you would not need to attach that form again unless you were later denied again. Another reason why you do not need to attach the form is you are taking the Earned Income Credit without a qualifying child for 2010, and the only reason your Earned Income Credit was reduced or disallowed in the earlier years was because the IRS determined that a child listed on the schedule, EIC, was not your qualifying child. Also, do not attach or file Form 8862 or take the Earned Income Credit for 2 years after there was a final determination that your Earned Income Credit was due to reckless or intentional disregard of the Earned Income Credit rules, or for up to 10 years after there was a final determination that your Earned Income Credit claim was due to fraud. So the IRS takes this pretty seriously, and I can remember in the early years when I got into taxes in the early 90s, that Earned Income Credit fraud was absolutely rampant everywhere, and in particular, then Senator John Glenn made it his mission to really crack down on Earned Income Credit fraud. And so what happened in tax season 1995 is the IRS put a hold on a very high percentage of all Earned Income Credit tax returns and demanded that filers who were claiming the credit prove that they were entitled to it before those refunds were released. And at any point randomly, the IRS can select any individual who qualifies or doesn't qualify, but any individual who has applied for the Earned Income Credit and ask them to prove they're entitled to it before they will release that refund. If the IRS determines on one of these types of audits that you are not entitled to the Earned Income Credit and that you had no business claiming it and knew you had no business claiming it, they can tell you that you're not going to get it this year, and for that matter, for the next 2 years, you're not allowed to claim it even if you do qualify. And if it was due to fraud, you can go 10 years and not be allowed to claim it. So exception for math or clerical errors: if your EIC was denied or reduced as a result of a math or clerical error, do not attach Form 8862 to your next tax return. For example, if your arithmetic is incorrect, the IRS can correct it. If you do not provide a correct Social Security number, the IRS can deny the Earned Income Credit. These kinds of errors are called math or clerical errors. Omission of Form 8862. If you are required to attach Form 8862 to your 2010 return and you claim the Earned Income Credit without attaching the completed form, your claim will automatically be denied. This is considered to be a math or clerical error. You will not be allowed to claim the EIC without attaching the form. So particularly with electronic filing, what we will find is that we have a client who was denied the Earned Income Credit in an earlier year. And when we don't attach the form because we didn't know that the client needed to attach it, that tax return will reject. And the reject code will tell us that we need to attach the form. So this is a pretty easy fix. We'll attach the form, provide the information requested on the form, and retransmit the return. Obviously, a person who is attaching Form 8862 to their tax return can expect significant delays in the processing of their tax return. And additional documents may be required. You may have to provide the IRS with additional documents or information before a refund relating to the Earned Income Credit is released to you, even if you attach a properly completed 8862 to your return. Here is the Form 8862, and you can see it's asking for a bunch of information, including the year for which you are filing the form. It asks for the number of days that each child lived with you. It also asks for the date of birth on each of the children, the Social Security number, and addresses of each of the children. So it also asks who else lived with those children. Was the child that you're claiming for the Earned Income Credit living with you and another person? And if so, who was that other person and what was their relationship to the child? It's getting into a lot of information. Now, what about us as tax preparers? Is there any rules affecting us with regards to this Earned Income Credit, which is, of course, such a target of fraud and is also such a target of IRS audits? Well, yes, there are some very important rules. There are rules called federal due diligence requirements that affect all paid tax preparers. If you are a paid preparer, you must adhere to the due diligence requirements as they are outlined by the IRS. The IRS says that you have exercised due diligence if you maintain a written record of your client interview, which shows you asked the questions necessary for determining your client's entitlement to the Earned Income Credit. Any tax preparer who fails to exercise due diligence is subject to a $100 fine per occurrence. The fine is assessed against the tax preparer directly and not against the preparer's employer. So let's just suppose you have an employing tax service who likes to turn a blind eye and instructs you not to bother with these due diligence questions. And if you do ask the due diligence questions, well, they might just let you go because they don't want to lose their tax clients because you were too snoopy. Well, the IRS says, too bad, Mr. Tax Preparer. We do not care what your employer ordered you to do. It is your job to exercise due diligence, and if you fail to do so, we are going to fine you for that failure and not your employer. Although they could, of course, go after the employer for other reasons, such as fraud. Now, earned income credit due diligence, what does that mean? Under IRS regulations, a tax preparer must not know or have reason to know that any information used in determining EIC eligibility or the amount of EIC is incorrect. In addition to completing Form 8867, Paid Preparer's Earned Income Credit Checklist, the preparer must also ask more questions if the information furnished by the taxpayer appears to be incorrect, inconsistent, or incomplete, and must not ignore the implications of information furnished or otherwise known. The inquiries made and the responses must be documented and the records maintained for 3 years. So let's just think about what this could possibly mean. Let's just suppose you work in a particular tax office and a client comes in and sits down and asks you to prepare their tax return. And it happens to be that you know this client firsthand and you know their personal living circumstances, and they provide you with information that is contrary to what you know to be the case. That would be an example where you need to ask further questions, either to correct what you understand, in other words, maybe your interpretation is wrong and that their living situation is different than you realized, or to inquire fully and confidently that they're not entitled to the credit at all so that you can follow that pattern. So let me think of an example where this might be the case. Let's just suppose that you have a relative, a cousin, for example, and you know that your cousin has no children. And then your cousin comes in and sits down and asks you to prepare their tax return and presents to you a Social Security card of a child that they claim is their foster child. Well, maybe they did get a foster child in the last few months that you're not aware of. So you would need to ask those questions. Oh my gosh, I didn't realize you had a child. When was the child placed with you? Do you have the placement papers from an authorized agency who placed that child with you? Those would be reasonable questions to ask because you have knowledge that contradicts what that person is stating in front of you. Now, it is not your job to be an investigative force. It is merely your job to exercise due diligence. Now, another example of where due diligence could come into play is a client comes in, you don't know them from anyone in the world, they're a new client to you. They come in and they present to you the Social Security cards of 3 children whom they're claiming on their tax return, and they want the earned income credit for those 3 children. And you notice that your client's last name is Jones, and that 2 of the children have the last name of Jones, but 1 of the children has the last name of Smith. So it would be a natural question for you to ask, I've noticed that this child here has the last name of Smith. Can you explain to me your relationship to this child? And you might get an answer like, oh, well, this child is my boyfriend's child, but he's letting me claim him this year. Well, then your response would be, well, if this child is your boyfriend's child, you cannot have earned income credit because this child is not related to you. Not only that, you may not be entitled to a dependency exemption for this child if you can show, or it can be shown, that that child was in fact the qualifying child of his own father. So you have to be thinking through all of these rules when you're applying due diligence. And getting due diligence correct means you ask questions, and you ask lots of questions. You ask questions that you might feel uncomfortable asking. You ask questions that your client may be somewhat offended by. What business is it of yours? Who else lives with me in my home? Why should you care about that? Well, as a tax preparer, you are required to care about that. You are required to ask these questions. And if your client is unhappy with that, then they'll have to live there unhappy, or you need to let them know you cannot prepare their tax return. That's what the IRS rules have to say about due diligence. So let's look at the IRS due diligence chart for ensuring compliance with the EIC regulations, and there's a URL in here you can follow if you want to read it firsthand. It contains the following items. Firstly, part of due diligence includes completion of the EIC eligibility checklist. You must complete Form 8867 or its equivalent, and you must complete the checklist based upon information provided to the tax preparer by the taxpayer. That would entail you need to interview the taxpayer and not get this information third party. Also, how you computed the credit. You must keep the Earned Income Credit worksheet or an equivalent that demonstrates how you computed the Earned Income Credit. There is the knowledge component. You must not know or have any reason to know that any of the information used in determining that taxpayer's eligibility for or the amount of the Earned Income Credit is incorrect. You must not ignore the implications of information furnished or known. You must make reasonable inquiries if information furnished or known appears to be incorrect, inconsistent, or incomplete. Number 4, record retention. Retain Form 8867 and the Earned Income Credit worksheet or the equivalent. You should maintain a record of how and when the information used to complete these forms was obtained. You must verify the identity of the person furnishing the information, and you must maintain records for 3 years after June 30th, following the date that the return or claim was presented for signature. So let's take a look at the Earned Income Credit Eligibility Checklist, because this is the first due diligence rule that must be applied. That is, that this form has to be completed for every client, or the equivalent of this form must be completed. Let's look at the checklist here. The first item on the checklist is you have to have income that is less than the amount shown for your filing status and the number of children you have. So it's worded as a question: is your AGI less than the amount shown? And you must answer yes. Number 2. Do you, your spouse, and your qualifying children each have valid Social Security numbers? If you answer no, you're out. Is your filing status married filing jointly, head of household, qualifying widow, or single? It must be one of those 4, and if it is, you answer yes. You must answer yes if you are not excluding foreign earned income. So most people would answer yes to that question. Is your investment income $3,100 or less? You would need to answer yes to that question. If you cannot answer yes to the question, you are out and you do not get the Earned Income Credit. Number 6, is your earned income at least $1 but less than the amount shown? You must answer yes, and if you cannot answer yes, you are out. Number 7, answer yes if you and your spouse are filing a joint return are not a qualifying child of another person. In other words, you cannot have the Earned Income Credit if you yourself are a qualifying child or a qualifying relative of another person. So you must answer yes, I am not the qualifying child of another person, because if you answer no, you're out. Now, does your child meet the relationship, age, residency, and joint return tests for a qualifying child? Is your child a qualifying child only for you? Yes, if your qualifying child does not meet the test to be a qualifying child of any other person, or B, your qualifying child meets the test of a qualifying child of another person, that you get to be the one who is entitled, essentially under the tiebreaker rules. Number 10, were you or your spouse filing a joint return at least to age 25? Well, I just wanted to point out here that Rules 8 and 9 apply only to people who have qualifying children. Rule 10 applies only if you do not have a qualifying child. And number 11, answer yes if you and your spouse, if filing a joint return, cannot be claimed as a dependent on anyone else's return. And rule number 12 was your main home and your spouse's if filing a joint return in the United States for more than half the year. So here at the footer it says, persons with a qualifying child, you must answer questions 1 through 9 with a yes, and complete and attach Schedule EIC. And persons without a qualifying child, you answer yes to questions 1 through 7 and 10 through 12 to qualify for the credit. And if anyone answers no to any of these questions, you are out and not entitled to claim the Earned Income Credit. So that completes the review, or the discussion rather, of the Earned Income Credit portion of today's lecture. I feel this would be a good point for you to do a couple of classwork assignments before we continue on with the discussion of more credits. So at this point, please flip to the back of your student manual until you get to page 28. And on page 28, you will see that there's a series of 5 questions, and these all relate to the Child and Dependent Care Credit. Please read through the questions and answer true and false to each question as you go. The next assignment is classwork number 2, and it asks you to compute the amount of Earned Income Credit for each of the following individuals using the attached tables. So let's go to the Earned Income Credit tables at point in time and show you how to use them. Let's just suppose that we have a filer whose income is $9,500 and they do not have a qualifying child at home. Then the earned income credit that they would be able to claim is $301. If that same filer had one qualifying child, then the amount of credit they would be allowed to claim goes up to $3,060. 2 or more children, $3,810, and 3 qualifying children is $4,286. Now, if we were talking about the same income level for a married couple, you go over to the second part of the chart, and you will observe that for much of the chart, the amount of earned income credit it remains constant regardless of the filing status. But as the income rises, that's where you will see that there are differences in the amount of earned income credit based on filing status. So for example, let's look at $15,000 or $15,500 of income. We will see that if you are single and have no children, that your earned income credit would be 0. If you have 1 child, then the earned income credit goes to $3,050, 2 children, $5,036, and 3 children, $5,666. And again, if you are married, there is no change there. But let's move up in income a little bit more and see what happens. Now here, when the income hits $21,750, you will see that if you are single and you have 1 qualifying child, then your earned income credit is $2,199. But if you are married filing jointly, that same child would qualify you for $2,999 of earned income credit. 2 children would give you $3,900 if you're not married, but if you are married at that same income level, you'd get an extra $1,000. And with 3 children not married, the earned income credit is $4,544. And if you are married, again, you can add an extra $1,000 to the amount of earned income credit you can receive. So filing status can have an effect on the amount of earned income credit you are able to receive, particularly as your income goes up in the scales. So at this point, please return to page 28 and 29 of your student manual. Complete classwork assignments 1 and 2, and when you are finished, please resume video playback for a review of the classwork answer keys for classwork assignments 1 and 2. So let's resume our lecture, and the first classwork assignment we're going to look at is classwork number 1. All of these questions relate to the Child Independent Care Credit, beginning with question number 1. Janice's husband, Harry, was disabled and unable to care for himself for the entire year. Janice hired an attendant to care for her husband in their home while she was at work. Janice and Harry will file a joint return, and they are eligible to claim the Child Independent Care Credit. True or false? Well, the answer is true, and the reason it is true, Janice can claim the dependent care credit even though Harry did not work because he was incapable of self-care. Janice may also be able to claim the cost of Harry's care as a medical expense. She cannot use the same expenses for both the dependent care credit and as an itemized deduction on Schedule A. She should claim the expenses as a dependent care credit or as an itemized deduction in the way that benefits her most. Question number 2. Laura is single, and she paid her 18-year-old son, Sam, to care for her younger children while she was at work. Laura will not be able to claim Sam as her dependent. Laura can claim the Child Independent Care Credit. True or false? Well, the answer is false. Even though Sam is not her dependent, he is Laura's child, and he is under age 19. Therefore, she cannot claim the credit for money she paid to him because he was her child who was under age 19. Number 3, Jill is married to Jack. Jack left Jill and moved out of the home on May 1st. Jill worked and supported their 2 children, ages 9 and 10, for the remainder of the year. Jill worked all year and paid more than half the cost of maintaining her household. She paid for before and after school care for her children while she was at work. She will not be filing a joint return with Jack. Can Jill claim the Child Independent Care Credit? Well, the answer is yes, she can. True, Jill meets the test for being considered unmarried for purposes of head of household filing status. Jill had earned income and paid child care for her children who were under age 13 so that she could go to work. She would not be allowed to claim the credit if her filing status was married filing separate. However, she can file as head of household because she meets those tests, and therefore she is entitled to claim the credit. Number 4, Betty and John are married. Betty worked all year. John was employed and looking for work for 2 months and a full-time student for 7 months. Their 2-year-old daughter was enrolled at preschool whenever John was at school or looking for work. Betty and John will be able to claim the Child Independent Care Credit for their joint return or on their joint return. The answer to that question is true. The credit can be claimed for the months that John was either a student or was out job hunting. You must prorate the credit at a rate of $250 for each month that he was actually going to school or looking for work. So if John was a student for all 12 months, the allowable expense would be $3,000. But since John was looking for work or was a student for just 9 months out of the 12 months, then his allowable expense will be 9 times $250 or $2,250. And number 5, Sally and Joe are married and both work full-time. Sally's mother, Winifred, lives with them and cares for their 5-year-old son. They pay Winifred to care for their son. Winifred is not their dependent. Sally and Joe can claim the Child Independent Care Credit. The answer is true because the payments were made to a non-dependent relative and they are allowable. So let's move on to classwork assignment number 2. And the first problem we come to is Jessica, who is age 24 and single. She has no children and is not a dependent of another filer. Her adjusted gross income is $8,000. What is her earned income credit? Well, the answer is 0. She is not age 25 or older, and so she is not eligible to claim the earned income credit. Now, if she had a qualifying child, she would be entitled to earned income credit, but we have told you she does not have a qualifying child. George, age 32, is married filing separate. George lived with his 3 children, age 5, 7, and 9 all year. All 3 children qualify as his dependents. His adjusted gross income is $23,000. What is his earned income credit? Another big 0. Married filing separate is not entitled to earned income credit. Martha is age 65 and single. Her 2 grandchildren, ages 8 and 10, lived with her for 8 months during the year. Her adjusted gross income is $8,590. Well, because she has qualifying children, her age is not relevant. Let's flip down to the tables and find out what her EIC is. We're looking for AGI and earned income of $18,590. So scroll till I get to that line. And here we have $18,590 would fall on this line. She has 2 children, so the earned income credit she is entitled to receive is $4,588. Moving back up to the next problem, Mr. H is also age 65 and Mrs. H, age 66, lived together all year. Their daughter, Sally, age 25, lived with them along with their grandchild, Bob, age 5. Sally's AGI was $16,575 and Mr. and Mrs. H's AGI was $46,000. Well, here's the deal. Mr. and Mrs. H could claim the earned income credit if Sally agreed to let them have it. But their income is so high, well, they wouldn't actually get any earned income credit. And since Sally wins under the tiebreaker rules, Sally is the one that would claim the earned income credit in this scenario. So let's go back down to the tables and find a single person with income of $16,575. And here we have it on this line, and you will see that Sally with a single child will be entitled to earned income credit in the amount of $3,030. And if we were to go down these tables until we look for $46,000 of income for a married couple, you will see it does go as high as $46,000 of income, but not when there is only one qualifying child. So $46,000 of income, the earned income credit for a single qualifying child, even when you're married, is 0. So it's definitely a situation that it is much more advantageous for the daughter Sally to go ahead and claim earned income credit on her own child. This concludes the review of classwork number 1 and classwork number 2 for session 11. Let's go back up into our manual and pick up where we left off at the end of when we took our break. And we're going to move on now to a discussion of the additional child tax credit on page 22. So we're on to the topic of the additional child tax credit. The child tax credit is a non-refundable credit. If your tax liability is 0 and you qualified for the child tax credit, you may qualify for the additional child tax credit. The additional child tax credit is a refundable credit. It is intended to refund certain taxpayer a portion or all of the Social Security and Medicare tax withholdings withheld on their W-2s. So who can claim the additional child tax credit? Well, there are rules for taxpayers who have 1 or more qualifying children, and there are rules for taxpayers with 3 or more qualifying children. We're going to look to the rules if you have 1 or more children first. To qualify for the additional child tax credit, you must meet all of the following rules. You have one or more qualifying children for whom you can claim a dependency exemption. You have more than $3,000 of earned income. You owe no federal tax. That is, the amount shown on Form 1040, line 55, is 0. You complete and attach Form 8812 to your tax return. Now, even if your earned income was less than $3,000, you may still qualify for the additional child tax credit if you have 3 or more qualifying children. Here are rules for people who do have 3 or more qualifying children, and you must meet all of the following rules in order to qualify if you're claiming the credit in Part 2. Firstly, you must have 3 or more qualifying children. You cannot owe any federal income tax. That is, the amount on line 55 of Form 1040 is 0. You must have completed Form 8812, Part 2, and you must have paid Social Security and Medicare tax or self-employment tax if you are self-employed. So how do you claim the credit? We'll calculate the credit on Form 8812 and then carry your credit to Form 1040, line 65. So before we move further on into today's lecture, I wanted to stop for a minute and just create a tax scenario for you so that you could see how the credits we've discussed today interrelate with each other. And so just off the top of my head, I've created a character named Darla. And Darla is a single taxpayer. She's divorced. She has 3 children, Joe, James, and Jennifer, who live with her as her dependents. They are all under age 19. And Jennifer, however, is not being claimed by Darla as a dependent because she is being claimed as a dependent on the return of her non-custodial father. So I wanted to take this information and show you how it would work on a tax return. I also felt that we should provide a child care expense. So let's just say that the child care expense that Darla has paid out during the year for the care of Jennifer so that Darla can go to work is $500, and that Darla has $22,000 of income. So let's just see what Darla's tax return looks like. And I actually paused the video recording just for a moment so that I could do something up in our tax software, and I've used Drake software to prepare Darla's return. So let's take a look at this form, the finished return for you, and we can see that we have Darla. She has 3 children, but even though she has 3 children who lived with her, one of those children is not being claimed as a dependent by Darla because that child, named Jennifer, is being claimed on the tax return of the non-custodial father. So Darla will enter dependency exemptions for 2 of her 3 children, Joe and James. And as I said, she has $22,000 of wage income for the year. She's claiming 3 exemptions, and she is claiming 2 children for the child tax credit. Let's move down to page 2 of her tax return and see what that looks like. Again, we have on line 38 her wage income. She is qualifying for head of household filing status, so we have the standard deduction for head of household. And then we subtract $8,400 from $22,000. We get $13,600. Next, we multiply $3,650 by the number of exemptions she's claiming, which is 3. We get $10,950. We subtract that out, and we're left with $2,650 of taxable income. We go to the tax tables and look up the tax on that amount of income, and we're left with $266 of tax. Next, we look to the Child and Dependent Care Credit. She had $5,000 or $500 of expense on $22,000 of income. So let's go over to the Form 2441 and fill that out. I just entered sample employer, the qualifying child for whom the expenses were paid, and then we look to see what decimal factor applies to the child care expenses that Darla paid for Jennifer. So Darla's income is $22,000. We find that on the table. That gives us a decimal factor of 31. We enter 31 on line 8. We multiply 31% by $500, and that gives us a credit of $155. You'll notice that we have to apply the tax liability limit, and the amount of tax liability shown for Darla is $266. So we subtract $266 from we make sure that the tax credit is not more than the liability. It is not, so we claim $155 as a child independent care credit, and we enter that on line 48 of the 1040. Next in line is the child tax credit, and when we calculate the child tax credit cannot be more than the tax minus other credits. So $266 of tax minus $155 is $111. We enter $111 on the line. When we add $111 back into $155, we end up entering $266 on line 54 and getting net tax of 0. The next step is to enter the Making Work Pay credit for Darla. She is entitled to $400. And we need to look up the Earned Income Credit. Well, let's go into the tables at the back of our manual to do that. So the tables appear near the end of the manual, and we're looking for the Earned Income Credit on $22,000 of income. So let's find that line. And here we have it, $22,000 of income with 3 children. So even though Jennifer is not Darla's dependent, Jennifer still is a qualifying child for the Earned Income Credit, so we will go for Earned Income Credit for 3 children based on $22,000 of income. That's $4,491. We enter $4,491 on line 64. The next step is to figure the additional child tax credit, and when we're figuring the additional child tax credit, we have to take the number of children qualifying for the credit multiplied by the maximum amount per child, and that would be 2 times $1,000 or $2,000. But then we have to subtract out the amount of child tax credit claimed on line 51, and after we've done that, we end up with $1,889. So that's the additional child tax credit that Darla is eligible for, and that leaves her with total allowed credits of $6,780. So even though Darla paid no tax in, she still will have a $6,780 refund for the year. Now let's just take a look at her finished schedule EIC, and you will see that the tax software, as I explained earlier, put the youngest child first, and it happens to be I just randomly entered dates of birth for these children, and it ended up that Jennifer was born in 2003, James in 2000, and Joe in 1999. The tax software entered the children in that order of age, but if you look to the front page of the 1040, the tax software entered the children in the order that I just entered them into the software. And of course, Jennifer's not listed at all. The next step, just looking at the Schedule EIC, is that you'll see the names of the children. We'll see the Social Security numbers of the children, and I just made those up, hammered them in, and the number of months the children lived with their parent. On 8812, we look at the number of qualifying children and multiply that by $1,000 per child. That is $2,000. We then subtract out the amount of child tax credit claimed, and that leaves us with $1,889. There's a second calculation going on here, and it's important to understand how that calculation works. The calculation says take the earned income of the taxpayer and subtract out $3,000, then multiply that difference by 15%. When we do that, we get $2,850, and Darla is eligible to claim the smaller of what's on line 3 or what's on line 6, and in this case line 3 is the lesser number. Now if Darla had 4 children, the amount that she would enter on line 1 would be $4,000, but she would not be allowed to claim more than the amount on line 6. And line 6 is her earned income minus $3,000 multiplied by 15%. And then we move over to Schedule or Form 8867. We wanted to show you a completed, or I wanted to show you a completed Paid Preparer Earned Income Credit checklist. And you can see here it asks for the year, and then it goes through and asks all of these questions to be answered. And this particular checklist does not match the IRS's checklist. Remember on the IRS checklist it said you have to answer yes to all questions. Well, this particular checklist asks the questions differently, so you could say that this is like a substitute Form 8867. But the thing is that this form is not filed with the tax return. It is kept by the tax preparer with the tax preparer's records, and it's simply a due diligence checklist. So it could be identical to the one in Pub 17, or it could be different than the one in Pub 17 as long as it asks similar questions to make the same determinations. So that completes that particular exercise. Let's move on to the next part of today's lecture, which is the adoption credit on page 23 of your manual, and that will be the final credit that we talk about today. The adoption credit was set to expire at the end of 2010. It had been around for quite a while, but it was set to expire. Then the Patient Protection and Affordable Care Act was passed. It is also known as the Affordable Care Act, and it extended the credit through 2011 and also made it refundable for 2010 and 2011. But now that the adoption credit is refundable, it means that you can get a refund from adoption care expenses even if you owe no tax. So we look here at our taxpayer Darla, who has no tax. Let's just suppose she adopted a child during the year. Her refund could potentially be even larger yet again, even though she paid no tax in and has no tax liability. And that's a first for the adoption credit. 2010 is the very first year it's ever been refundable, and it's a temporary status that it will be refundable for 2010 and 2011 only, and it is a huge credit. Previously, the adoption credit was non-refundable, meaning that it could only be used to reduce your tax liability, but credit amounts in excess of tax liability could be carried forward for up to 5 subsequent years. Now, if you carried forward an adoption credit from 2005 or later, because the credit was more than the tax you owed, you can claim the carry forward amount as refundable credit in 2010. So let's just suppose, I don't know, for example, in 2008 you had a non-refundable credit of $10,000, but you couldn't claim $5,000 of the credit because you didn't have any tax, and that $5,000 flowed through to 2009, and you had no tax in 2009. So coming into 2010, that $5,000 is carrying forward. Well, in 2010, even if you don't have a tax liability, you can get that money refunded to you. So you can find the amount of any unused carry forward credit that you could be allowed to claim on line 23 of the worksheet of page 5 of the 2009 Form 8839 instructions for the qualified adoption expenses. Now, for 2010, you can claim a credit of up to $13,170 for the qualifying expenses you pay to adopt an eligible child, and that is per child. So if you adopt more than one child during the year, let's just say you adopt 2 children, you could potentially have a $26,000 refund coming in 2010. Now, an eligible child is any individual who is under age 18 or physically or mentally incapable of self-care. You cannot claim the credit if you adopted your spouse's child. If you receive adoption assistance benefits from your employer, you may be able to exclude all or part of them from your taxable income, up to $13,170, but you cannot claim both a credit and an exclusion for the same expenses. The adoption credit phases out when your income is between $182,520 and $222,520 of income. That's a fairly generous income level, and it's a fairly recent period in time where the income level was brought to that big a number. For a long, long time, it seemed to be the case, for at least with the clients I worked with, that anyone who had enough money to afford to adopt a child earned too much to get the credit. But about 5 years ago, the amount of income you could earn and still receive the credit rose dramatically to a level where I now find it the case that virtually everyone I work with who did adopt a child is able to claim at least a partial credit. So this is a fairly generous income range for that particular credit. So what are qualified expenses? Qualified adoption expenses are reasonable and necessary adoption fees and can include court costs, attorney fees, the cost of traveling, including amounts spent for meals and lodging while away from home, other expenses directly related to the legal adoption of an eligible child, and expenses paid in an unsuccessful attempt to adopt an eligible child before finalizing the adoption of another child can also qualify for the credit. Qualified adoption expenses, however, do not include the cost of adopting your spouse's child for a surrogate parenting arrangement, or that violate state or federal law, are paid using funds received from federal, state, or local programs, paid or reimbursed by your employer or any other organization, or allowed as a credit or deduction on a federal tax return. Expenses connected with a foreign adoption where the child is not a U.S. citizen or resident at the time the adoption process began qualify only if you actually adopt the child. There are some important rules you should know about adopting a child who has special needs. If you adopted a special needs child, you can claim an adoption credit even if you had no qualifying expenses. A child with special needs is defined as follows. To qualify as a special needs child, both of the following rules must be true. Your adopted child must be a U.S. citizen or a resident of the United States at the time the adoption process began. A state, including the District of Columbia, must have determined that the child cannot or should not be returned to his or her parent's home and probably will not be adopted unless adoption assistance is provided to the adoptive parents. Factors used by states to determine if a child has special needs could include the child's ethnic background, the child's age, whether the child is a member of a minority or sibling group, and whether the child has a medical condition or a physical or a mental or emotional handicap. If your state has determined that the child you are adopting is a child with special needs, you must attach a copy of that state determination of special needs to your tax return. Now, this is a question that you should be asking of your clients when they've adopted an American child. Because if they adopted a child from inside the United States, it is an automatic thing that you should be asking, was this child special needs? And very often, the taxpayer who adopts a special needs child may not even be aware that their child is special needs or consider that their child is special needs. For example, a few years ago, I did a tax return for a woman, an African-American woman who had adopted her niece. And she had adopted the niece in an earlier year. And so I was working on preparing her tax return and asking her for her children's names, and she provided me with the name of her niece, and the niece had a different last name than she did. And so I said, oh, okay, can you explain to me how it is that your child has a different last name than you? And she said, well, she's my niece. And I said, okay, well, where are the parents? Because that's part of my due diligence. I have to find out where the parents are before I can just automatically let her claim. Well, as the conversation unraveled, I found out that she had actually adopted this child. And the parents of the child were either out of the picture in prison. I don't remember the specifics of that, but they were gone, out of the picture, and she had adopted this child. Well, I immediately began to think that this probably was a special needs child, and I said so. And my client was taken aback by that. There's nothing wrong with her. She's perfectly healthy. How can you call her special needs? And I said, hey, it isn't me who decides what special needs is. You need to actually go back to the state that helped arrange this adoption with you and determine whether or not this child met the state definition of special needs. And when she did that research, she came back and she said, yes, the state does say that my child, it was special needs, that this was a special needs adoption. The reason why the child was special needs, the child belonged to an ethnic minority group. The child was past a certain age. There could have been other reasons as well, but those were two key reasons. So even though the child had no physical or mental or emotional handicap at issue, the child was old enough and the child belonged to an ethnic group that made it difficult for that child to be adopted otherwise. So she qualified, and what that meant was she was able to claim an adoption credit even though she had no adoption expenses. So who can then take the credit or exclusion? Well, firstly, we have to decide or establish whether the child that has been adopted is a U.S. citizen or resident or was a foreign child. And there are rules that differ between those two categories. So let's look first to the child who is a U.S. citizen or resident. If the eligible child is a U.S. citizen or resident, you can take the adoption credit or exclusion even if the adoption never becomes final. Take the credit or exclusion as shown in the following tables. If you pay the qualified expenses in any year before the year the adoption becomes final, then take the credit in the year after the year of payment. If you pay the expenses in the year the adoption becomes final, then claim the expenses in the year the adoption becomes final. And if you pay the expenses in any year after the year the adoption becomes final, claim the expenses in the year of payment. If your employer pays for qualifying expenses under an adoption assistance program in any year, then you take the exclusion in the year of payment. So for a foreign child adoption, if the eligible child is not a U.S. citizen or resident, you cannot take the adoption credit or exclusion unless the adoption becomes final. Take the credit or exclusion as shown in the following tables. If you paid qualifying expenses in any year before the year the adoption becomes final, then you take the credit in the year the adoption becomes final. If you pay the qualifying expenses in the year the adoption becomes final, you claim them in the year the adoption becomes final. And if you pay any expenses in a year after the year the adoption becomes final, you claim those expenses in the year of payment. Note that if your employer makes a payment in a year before the adoption of a foreign child is final, you include the amount in your income for the year. When the adoption is final, exclude the amount from your income on your return for that year. So how do you claim the adoption credit? Well, you figure the credit on Form 8839, and then you claim the credit on Form 1040, line 71, and check box B. And here is line 71. And there is line 71, check box B, Form 8839. Now I should point out that because of the size of this credit and the fact that the IRS wants the taxpayers to attach proof of adoption, that any taxpayer who claims the adoption credit in 2010 or 2011 is required to file a paper return. So starting in 2010, you must attach to Form 8839 one or more adoption-related documents to support your claim for the credit, whether the credit is for a 2010 adoption or an adoption attempt, or for a credit carry forward from a previous adoption or adoption attempt. Documentation requirements vary, so refer to page 4 of Form 8839 instructions for more information. And because of the new documentation requirements, if you are filing Form 8839 to claim the adoption credit or to exclude from income any employer-provided adoption benefits, you cannot file your income tax return and Form 8839 electronically. You must file paper returns. Well, we've now been through our first tax season with this refundable adoption credit, and I can tell you it was rather nightmarish for our clients who did qualify for the credit. Nightmarish in that it was never enough. No matter what documentation we attached to the tax return, the IRS still sent letters saying it was not adequate. And actually today, one of my tax preparers came into my office and she said, "I did it. My final outstanding adoption credit tax return from the tax season was released today." So we're talking that it is August 30th for tax returns that were filed during the tax season of this year, and today is the day IRS finally was satisfied with everything that we'd provided to them on the applications for the adoption credit. So the bottom line behind that message is that anytime you are helping a client apply for the adoption credit, you need to make sure you attach all required documentation, and you should also go out of your way to explain to your client that their refund is not going to come quickly, that there's going to be considerable delays while the IRS goes through and verifies their entitlement to that money. And given that we're talking about over $13,000 of money, you can understand why the government is taking its time and being very careful. Now, how do you deal with that problem? Well, one way to deal with the problem is that if your client has a refund outside of the adoption credit, it may be worthwhile to them to file electronically without the adoption credit and then file an amended return to which they attach that adoption credit form, so that they can at least get what portion of the refund they're entitled to sooner, and then go through the normal, usual waiting process for the rest. So what records should I keep to claim the adoption credit or the income exclusion? You should keep the following documents to make sure that you are allowed to claim the credit and can prove that you're allowed to claim the credit. Receipts for qualified adoption expenses, entry visas for foreign adoptions, final decree, certificate, or order of adoption, home study by an authorized placement agency, child placement agreements or court orders, determination of special needs status by a state or the District of Columbia. Here is an illustration of how to figure the adoption credit, and in this illustration we decided to give you an adoption credit carry forward from an earlier year. In 2010, Cindy Sometime finalized the adoption of her daughter, Sally Sanders. Cindy filed Form 8839 in 2009 to claim qualified adoption expenses that she had incurred before the finalization of her daughter's adoption. In 2009, Cindy's tax liability on Form 1040, line 36 was $88.46, which left her an adoption credit carry forward for 2010 of $3,704. She will file as head of household, and her W-2 shows the only income she had for the year, which is $70,000. So let's look at her finished 8839, and we will see when we enter the name of the child, that this child is a child with special needs. And we then enter on line 2 the amount of qualifying expense for the year 2010, which is $13,170. We then subtract out the maximum credit that was possible in 2009, and that was $12,150. And we can see that there's a difference of $1,020. Oddly enough, this $1,020, even though it's for a year other than the year where she has qualifying expenses, she's still going to be able to get that $1,020. We look at income phase-outs by entering $70,000, and we see she is not affected by any income phase-outs. We take the $1,020 difference between last year's credit and this year's credit. We add that to the carry forward she had from the earlier year of $3,704, and that leaves her with a refundable adoption credit for 2010 of $4,724. So that concludes the lecture portion of session 11. The final classwork assignment of the day is to prepare a tax return for Powder and Sioux Blue. and prepare Forms 1040, Schedule A, 2441, and the Adoption Credit 8839. Powder Blue works as a manager and is married to Sue Blue, who is a homemaker and a full-time student at Ohio State University. She attended university all months of the year except June, July, and August. On June 1, 2010, they have finalized the foreign adoption of their daughters Sally Blue and Cindy Blue, and the Blues incurred the following expenses. For Sally, they had expenses in 2009 of $13,000, and in 2010 they had $7,000. For Cindy, they had adoption expenses in both years as well. During the year, the Blues paid little ones child care for the care of their children, and they paid $8,000 for the care of Sally and Cindy while Powder worked and Sue went to school. The children attended the school from July through December for 6 months. The Blues lived at 14 Tang Lane. They paid $20,000 in mortgage interest and $4,500 for property taxes. They also had $1,000 of dividend income. They have a W-2 attached. Go ahead and prepare their tax return. And you can see that this is the only income they had for the year, aside from what I've already mentioned, $179,000 of income, and they have a Making Work Pay credit of $200. So go ahead and push pause at this point. Complete the tax return for Powder and Sue Blue, and when you are finished preparing their tax return, please resume video playback for a review of the answer key. So I have up in front of you now the answer key for classwork assignment number 3. Powder and Sue have adopted 2 foreign children, and the expenses they paid in 2009 qualify for the adoption credit in the year the adoption becomes final, and that's 2010. And since the adoption became final in 2010, the adoption expenses they paid in both 10 and 9 are used to calculate the credit for 10. So we have adoption expenses in 9 for Sally and Cindy, and adoption expenses in 2010 for Sally and Cindy. We can see the total cost of adoption for Sally was $20,000. The total cost of adoption for Cindy was $13,000. The Blues income is from W-2 wages of $179,000 and $1,000 of dividends. And on to their 2441 important points for you to know. Sue Blue did not receive earned income during the year. She did, however, attend school full-time. She can claim $250 per child for each month she attended school full-time. She attended school for the entire year. However, the children were enrolled in child care only for 4 months that Sue actually attended school. This means that Sue can claim 4 months times $250 per child. That's $2,000 of qualifying expense. And let's move over and take a look at their finished return. We can see that we have Powder and Sue Blue filing a joint return. They have 2 children, both of whom qualify for the child tax credit, for a total of 4 exemptions. We have $179,000 of wage income, $1,000 of dividend income. Adjusted gross income is $180,000. Moving over to the adoption credit form. We have Sally Blue and Cindy Blue entered as the qualifying children, and we've checked the box that these are foreign adoptions and that the adoption became final in 2010. The next step is to enter the maximum possible qualifying adoption expense, and we'll see that the maximum possible per child is $13,170, and so we enter that number on lines 2 and 4. There was no adoption claimed or adoption credit claimed in an earlier year that can reduce their qualified expenses. But we do see on line 5 that adoption expenses for the 2 children differ, and so we enter the appropriate amounts. That is Sally being $20,000 and Cindy being $13,000. On line 6, we enter the lesser of the amounts shown on lines 4 and lines 5, and we end up with $13,170 being the lesser amount for Sally, but $13,000 even being the lesser amount for Cindy. So we get total qualified expenses eligible for the credit of $26,170. Then we look at their modified adjusted gross income. Are they subject to a phase-out? Well, the answer is no. Their income is less than $182,520. So their credit will be allowed in full, and they will enter $26,170 on Form 1040, line 71. Going back up to Form 2441, I just wanted to show you the Child Independent Care credit that we're figuring for Powder and Sue Blue. We enter the name of the child care. We enter the name of each qualifying child. We enter the amount paid to the child care organization and the amount of qualifying expense for each child, which is $4,000. The maximum qualifying expense is $6,000. The amount of qualifying expense for the children is $6,000. However, we have to bring in the earned income limits. We enter the earned income for the taxpayer, and then we also have to enter in the earned income for the spouse. Well, Powder's earned income is $179,000, but Sue was a student and can only be treated as having earned income for each month that the children were in daycare while she was attending school. And that gave us that $2,000 number. That was 4 months times $500 or $2,000. So the credit will be based on that $2,000 times 20% because their income is, of course, over $43,000. That gives them a qualifying credit of $400. Their Schedule A is also completed, and it shows income taxes on line 5 that were withheld on the W-2 of $15,000. There's the W-2, there's 15. Then we have real estate taxes, $4,500, mortgage interest of $20,000, total itemized deductions are $39,500. Let's go to page 2 of the 1040 and finish things off. We start with adjusted gross income on line 38. Then we enter the itemized deductions. The exemptions deductions, that will be $3,650 times 4. That's $14,600. We subtract all of that out, and we end up with taxable income of $125,900. The tax tables do not work for us here. It's necessary to compute the tax manually using the tax rate schedules. And when we do that, we get $23,838. We subtract out the child and dependent care credit. The Blues earn too much money to be eligible for the child tax credit, so that line is 0. And then we go over to their withholdings and enter withholdings on line 61 of $25,000. They were eligible for a partial making work pay credit in the amount of $200, and we then enter their adoption credit for the year. Their total credits and withholdings are $51,000, and that leaves them eligible for a refund in the amount of $27,932, which they can expect to wait several months to receive. So that concludes the review of the Classwork 3 answer key. Let's move on and take a look at your homework assignment. And today's lecture has been a little bit shorter than some of the lectures we've had, but I'm going to make up for that by having you spend a little bit more time on homework. And the reason for that is that I think the way for you to really begin to grasp the concepts that I've been discussing with you today, especially with regards to the earned income credit and the child tax credit, is to really spend some time working through it on your own. The first assignment we have involves Jack Spratt, who will be married filing separately and has 3 children he claims as dependents. We then move over to homework assignment B, and everything in homework assignment B is the same as homework assignment A, except we wanted to make Jack a divorced taxpayer and therefore give him a different filing status. So A and B are essentially the same information. The only difference is the filing status, and we want you to see how that changes his tax situation. So please do 2 separate tax returns for Jack, figuring his tax 2 different ways. And then homework assignment number C. And this is the assignment I think you will find the most challenging, but also the most rewarding in terms of what you will learn. And here we have Jack and Sylvia, who are an unmarried couple who lived together all year. They paid more than half the cost of supporting the following children who lived with them all year. And we will see that we have the child's name, the age of the child, and the relationship to Jack and the relationship to Sylvia. We want you to think through and reflect upon all the information we've given you. And among the pieces of information you need to look at is that Jack's earned income and adjusted gross income is $23,000, and that he paid 51% of the cost of keeping up his home. He received $200 of housing assistance each month last year and paid $500 for after-school care for George during the year. Sylvia's earned income and adjusted gross income is $24,000, but she only paid 49% of the cost of keeping up her home. She received $400 in food stamps each month of the year and paid $2,500 of child care expenses for her daughter Becky during the year. Please read through each of these questions and enter the answer that you think is the most appropriate. And then finally, we have a couple of tables. And this is the part that will be the biggest challenge, but as I said, will also help you learn the most. What are the possible tax return and potential refund scenarios for Jack? So let's look at the dependents that Jack might possibly be eligible to claim and figure how much his refund would be from claiming those particular children. And you can see we have George and Samantha, George, Samantha, and Becky, George, Samantha, and Jonathan, George, Samantha, Becky, and Jonathan. So those are the possible scenarios for Jack, and we want you to figure his refund under each of those scenarios. Then we have the same type of chart for Sylvia, but in Sylvia's case, we want you to examine claiming Ben and Becky, claiming Ben, Becky, and Jonathan. And then the final step is to say or answer the question, based on these calculations you've done on the two charts, who do you think should claim which of the children so that the overall refund going into this family is as large as it can possibly be? So obviously we can make it so Sylvia's refund is larger and Jack's refund is smaller, or vice versa. But where do we get that sweet spot where they're getting the best overall tax benefit legally entitled to them based on the information included in this problem? So have fun with your homework assignments, and we will see you back here at the beginning of session 12. The last thing I need to do today is to give you the final password of the day, and you did see that flash by a minute ago. Here it is. The final password to give you today is the classwork answer key password, and that password is Mustang, M-U-S-T-A-N-G. Thank you, and bye-bye.